Welcome to Business and Beyond, the podcast where business leaders and big ideas meet real-world challenges. I'm Julie Wheeler, President and CEO of the BBB serving Western Virginia. Each episode, we will bring you candid conversations, expert insights, and real-life stories to help you lead with purpose, build trust, and grow your business with confidence. Hello, and thank you for joining us. I'm Julie Wheeler, President and CEO of the BBB serving Western Virginia. On this week's episode, we're discussing recent federal tax reforms and what they could mean for businesses nationwide. I'm joined by certified financial planner Wayne Firebaugh to break down what business owners can expect this tax season. Wayne, thank you for being here with us today.
Thanks for having me, Julie.
Always love hearing your expertise. You know, we've been friends for a long time, so I always know who to call.
We're still so young, too.
I know. You know, we're going backwards, not forward.
Right, that's right. That's right. Looking forward.
There you go. Well, so I know you, but why don't you tell everyone else a little bit about yourself, your history, where you come from, what you do, all that good stuff.
Okay. Well, by training, I'm a CPA. I'm sorry to my Hokie friends, but I went to the state's other school. I went to the University of Virginia. Worked for about 8 years in Chicago with one of the big six accounting. There were six then. There's only four now. One of the big six accounting firms.
Before that.
They were the eight before that. They were eight before that. Yeah. And worked on the audit side for a couple of busy seasons, and then transitioned to one of the financial advisory firm branches in the firm. My area of specialty was troubled company and bankruptcies.
Ooh, wow.
So I got a lot of experience analyzing companies' financial records. Wife and I moved back to Virginia from Chicago, moved back to Virginia, and have been here for a long time. And since then, I have a registered investment advisory firm. We're fiduciary financial advisors. But we did end up doing a lot of tax analysis and a lot of work with small businesses, right, as they're trying to create their wealth. So all that stuff from the CPA days comes back into play. Sure. as you're helping companies look at their finances.
Well, obviously, this year has seen a lot of changes with the change in the federal administration, but one of the things was the One Big Beautiful Bill Act. I prefer to say OBBBA.
It's hard to say, isn't it?
It is a lot. It's a mouthful. But yeah, whether it's the words or the letters, it's still a mouthful. But it does have some pretty significant tax reforms, which, you know, it's more, I guess, the most since we've had since 2017 when they did the Tax Cut and Job Acts. I mean, yeah. Okay, you kind of have to pull the COVID years out because all the crazy stuff that happened then, you know, was weird. But so it's going to be impacting a lot of people and a lot of businesses. So what are some of the biggest changes you see, and what's going to impact those of us that live around here or own a business?
Yeah, and actually, to some degree, it's one of the most significant pieces of tax legislation going back to the Ronald Reagan years, the 1987, the Tax Reform Act back then. So there's a lot in there, and what's nice is a lot of the provisions under the Tax Cut and Jobs Act of 2016 were scheduled to sunset or expire.
Right.
And that makes it difficult to do tax planning, whether you're an individual taxpayer or you're a corporate taxpayer. It makes it difficult to do tax planning when the tax laws are changing.
Okay.
And so in all of our tax software and planning software, you'd have like this little checkbox that say, okay, plan for sunset of the Tax Cut and Jobs Act.
Oh, wow.
And so now we have, at least in some areas, certainty. Of course, there are some wags that talk about the tax code is written in pencil, right? It can change when the next administration comes around and the parties change. But for now, we have some certainty.
Okay.
And as it relates to corporations or small business owners, who's our primary focus here today, one of the biggest changes is in the qualified business income deduction. Okay. And the qualified business income deduction essentially allows a tax deduction for what we call pass-through entities. And a pass-through entity is a type of corporate entity where the entity's taxable income ends up on its owner's tax returns.
Right.
So commonly we'll think of things like subchapter S corporations.
Right.
Those types of corporations, the taxable income, the corporation does file a tax return, but the taxable income flows through to the owners, and it gets reported on their tax returns.
Just at whatever rate they
At
have
whatever
to be,
rate,
whatever
rate they
situations
pay,
are.
and
Right.
the highest tax rate for individuals is 37% under and we're talking federal law.
Right,
Virginia,
sure.
Virginia
Has
or
their
other
thing,
states
sure.
had their own, but
Right.
under federal law, the highest rate is 37%. And so what they did under the Tax Cut and Jobs Act is they capped corporate tax rates at a federal level at 21%. And so this is for regular corporations,
Right,
what we
C
think
corps.
of as C corps.
Right.
And so there's an inherent unfairness in that.
Right.
And so what the Tax Cut and Jobs Act did is it implemented the qualified business income deduction. Right, the QBID. Right,
Another acronym.
I'm convinced there are some congressional staffers somewhere in the basement eating pizza
Coming
and
up with
drinking stale
acronyms.
Warm beer, coming up with acronyms.
You may be right.
Right, maybe.
Yes.
But so recognizing an inherent unfairness of that, they put in this qualified business income deduction because now I have a disparity. I have the top personal tax bracket is at 37%.
Right.
The top corporate tax bracket is at 21% at a federal level. It hardly seems fair
Right.
that Apple pays tax at 21%, while one of our Better Business Bureau of Western Virginia members pays tax at 37%.
Right,
Hardly
sure.
seems fair.
Right.
And some saneness came into Congress when they came with this. So what they did is they put it in the qualified business income deduction that allows a deduction on your personal tax return if you have one of these pass-through types of corporations.
Okay, to give you the break to get it back, to
try
make it even it out a little bit.
Try to equalize it. Of course, it's never perfect, but it does
Right.
it does improve it. That provision was scheduled to expire at the end of 2025, and the OBA. What do you want to call it? The One Big Beautiful Bill Act, which is hard to say, so we'll call it OBA, extended that and made it permanent. So now you have this qualified business income deduction. A couple things to note about that. The first is that it phases out. And so not everybody's going to be able to use it. The second thing is it doesn't apply often to professional corporations. And so
that's my next question.
Yeah. So there is some limited application to professional corporations, but if you have a certified public accountant or you have an attorney or somebody like that makes
Right.
$750,000 or $1 million, there's a good chance their use of the qualified business income deduction is going to be limited on two levels. One is because of the phase out based on income for everybody, and two,
Right.
because there is a limitation if it's not a qualifying business. So, the IRS giveth and the IRS taketh away.
Right.
But at least we do have some now we have some certainty as it comes to planning, which is a nice thing. I mean, many people, when we're doing tax planning, again, whether at a corporate level or at an individual level, we'll deal with the law as it happens. The thing that is difficult to plan for is to plan for uncertainty.
Sure, absolutely.
In the law.
Right. So the professional corporations are not going to get the benefit of these changes. Is that
That's
kind
right.
of
That's going to be
bottom line?
That's right. Yeah.
Okay. Well, now we've been talking about bonus depreciation. That was something that, golly, that started back when I was a CPA doing stuff where they would give you first year write-offs or whatever. So did something change in this latest bill about that, and how can it be used by business owners?
Yeah, the bonus depreciation essentially, I mean, and just so we're all on the same page, what depreciation allows you to do is it allows you to take, if you're buying some sort of fixed asset for your business, so you buy this microphone or you buy the cameras that we're on here in this room, what depreciation allows you to do is it allows you to take an expense, a tax expense for that particular asset.
Right.
And it can be, again, the microphone, it can be the camera, it could be the building we're in.
Right.
Okay. And so the depreciation allows me to take those sorts of fixed asset costs into my income and deduct them as expenses over a period of time. And the IRS, the tax code assigns useful lives to these sorts of things. And so this microphone stand has a certain life. The camera has a certain life. My vehicles, my buildings, those have different lives. And so what, as a taxpayer, oftentimes what I would like to do is I would like to accelerate that depreciation as fast as possible.
Right.
You know, I buy a new car. I'd like to deduct it this year.
Right.
And so the bonus depreciation, what it allows me to do is it allows me to accelerate the depreciation and take much more of it in the current year. That was scheduled to start phasing out in terms of being able to take bonus depreciation. Now it's back at 100%, and so many asset classes now I'm going to be able to, for the things that our viewers and listeners are buying, you know, not buildings, but things
but
like
vehicles, pieces of equipment,
I'm going to be able to depreciate those much faster.
Right.
This allows me, from a tax planning perspective, as I'm getting to the end of the year and I'm managing my taxable income, allows me to more strategically plan my asset purchases and maybe keep that cash that I would have paid in taxes, keep that in the business to fund other things.
Are there limits, like a certain amount each year you can take that's accelerated or additional, or is it done asset by asset? You know, rather than a 5-year life, it's a 3-year life, or is it way too simplified?
That's probably going to be one of those things before any given and before you get into buying assets. Talk to your tax person.
That's probably fair.
And make sure, because again, assets have different lives, and make sure that you're having the conversation. There are a few things that frustrate your tax professional more than you coming in on you bringing your
on March 12th.
March 12th and going, well, you know, what should I have done? And so talk to your tax professional as you're moving into October and November and start thinking about what your asset purchases are going to be. Hopefully by that point you're starting to have some sort of idea of what your year's going to look like anyway.
Right. So if you can accelerate that expense, you can reduce your tax income.
Yeah. But at the same time, if you're having a bad year, you might not want to do it.
Well, exactly.
Right? Because bonus depreciation is automatic.
Oh, okay.
And so you
can't make a choice.
You can make a choice, but you got to make an affirmative choice to elect out of it.
Oh, okay.
And so you might go, you know what, we really didn't have a very good year, but we needed to buy a piece of equipment anyway.
Sure.
Well, I might not want to take all that bonus depreciation this year,
right?
Because I didn't have a good year. I'd rather defer some of that depreciation, some of that tax expense to next year when I look to have a better year.
Can you make that election each year? Do you have? Is it a one-time deal?
You can make it. You can make it each year. Yeah.
Okay. Is there any catch to the bonus depreciation? Is there something that you need to be aware of besides?
I'm trying to think of. Well, one thing to think of is you've got you're always under two different tax regimens, right?
Yep, sure.
Yeah, well, your tax in book, and so you got to be mindful what your taxes say versus what your books say.
Right.
Do you have, if you're a contractor, do you have bonding requirements or something like that? But you also have to be mindful of many states don't conform to federal tax federal
then
tax
you get
law.
differences,
So
yes.
in some areas, of course, we're in Virginia, but in some areas, Virginia law conforms to federal law, and in other areas, it does not conform to federal law.
Then it becomes an adjusting or a reconciling item, and that's why you need a good tax professional.
That's right. That's why you need a good tax. That's why you need a good tax professional.
Yeah, so they can get very complicated very fast.
Yeah. The thing is, and you and I both studied and are licensed as CPAs, and so one of the things I note is that, again, I don't do people's tax returns, but I do find that people oftentimes don't get to their CPA. We're joking about getting to your CPA on March 12th.
That's only for corporate. For personal, it's April 12th.
Oh, yeah, it's April 12th, or maybe it's April 16th. And should I have filed an extension?
Yeah, should I have filed an extension? Should I have made it a deposit? Yeah. Sure.
Get to your CPA or your enrolled agent or whoever you're using early, so that you can start to plan that in advance. Oftentimes, I find the CPAs are not as proactive either about reaching out,
right?
Because they're so focused. You get a CPA, their cycle ends, essentially October 15th. With the final rounds of tax returns, they're exhausted.
Taking a deep breath,
and so they might not be thinking about you in the first part of November. So you have to be proactive and go to your CPA, go to your enrolled agent, whoever your tax professional is, and say, I'm thinking about do I need to take steps to reduce my income this year? Whether it be like we're talking about asset purchases, maybe it's making extra contributions to my profit sharing plan or something like that. Your tax professional can help you a whole lot more at the end of the year.
Beforehand, you
get to that March 12th.
Then you're looking at.
There's not a whole lot you can do.
Monday morning quarterback and ain't going to help much.
Yeah,
definitely. Research and development is probably something that a lot of small business think, I don't do research and development. That's for big corporations. But there were some changes related to those, the expenses. Is that correct?
There were, and it's. When you go back and it's a head scratcher as to why they decided to do it to begin with. They changed the law, and you had to take a research and development over 5 years. Now they've
amortizing
amortizing it.
Yeah.
Right, which that's about the worst of all possible worlds. When you have cash outlay in 1 year and you can't deduct it until over 5 years.
Sure.
It really had, politicizing, not too much politicizing, but it does have the effect maybe of chilling research and development.
Sure.
And so under OBA, they brought that back and they said, okay, you can deduct it all you can deduct it all as a taxable expense in the year you incur it. Now, most of us think about research and development, and we've got this picture of people in lab coats standing
pharmaceutical development.
Yeah, pharmaceutical development.
Sure. But
it's broader. It is broader than that.
Give me some examples. What would a small business locally do that might be considered research and development?
Yeah. Maybe you're developing a software.
Okay.
Right.
Yep. Okay.
You're developing some sort of software, and so previously you might not be able to take all that expense for the development of that software in a single year.
Right. Okay.
You'd have to amortize it.
Sure.
Maybe you're a construction company and you're developing a new process for. Well, I understand little about construction.
Digging up something, or
right. You're developing
brickwork. Or
you're some sort of process for improving construction. That's research and development. And it's
improving efficiency.
Yeah, improving efficiency.
It could even be stuff that you're doing, testing different AI opportunities or options, whatever. Okay.
Yeah. And another thing that bothers me about those pieces of the law is it's one thing when you take away the ability of a company to have those sorts of deductions. They have the cash outlay, and they've got to amortize it. But it's also, I think, regardless of your political leanings and how you view the role of government, I don't think that it is a good thing when the government creates complexity in the tax law that makes it easy for innocent people to go, I just didn't understand that. Right? Just like you asked me and said, well, what would a small company do as research and development? And you're like, Well, and a small company go, we never even thought about that.
Yeah.
We don't view that as research and development.
Right.
We
That's
view
just business.
That's just business.
Day-to-day.
That's just business. We're developing software. We're improving our excavating methods or whatever.
Yep.
And so it creates a possibility for well-meaning, otherwise law-abiding taxpayers to run afoul of the law. And to me, somehow that just doesn't seem equitable.
But
so
it did change.
It did change, and I'm glad it
so
did.
That actually will take some complexity away, which is nice.
Always a good thing to take complexity away.
Absolutely. Well, the one thing that most business owners, if they haven't heard about it, they should have from whoever does their payroll. But there were some significant changes as it relates to tax on tips and on overtime.
All right, that is right.
Correct.
Do you get tips? I don't get any.
Well, no, they won't tip me. The only tip I get is don't use wooden nickels.
Yeah. My young adult kids give me tips, and they're usually not very helpful.
Well,
they're usually not very helpful.
My adult children give me lots of tips, which I just roll my eyes and go, "Did I really raise you?"
I understand.
Yes, you get it. Yes.
Better than many, right?
Yeah.
It's two changes there. One is the elimination of taxes on tips, which it's I think. Well, again, politicizing it was probably a good thing because you wonder how easy that was to enforce anyway.
Right.
But yeah, so now up to $25,000 of tips can be excluded, which is that was retroactive to January 1st, 2025.
Oh, wow. So this year's people doing their 2025 tax return. That's impact.
And the other thing that was the tax on overtime. And
I missed that.
Yeah.
I missed that in all of the hubbub and everything when all this stuff happened. And I just keep getting these alerts. Remember, there is no tax on overtime. You have to change this in your payroll system.
Right, and so you think about now is it we talked about a minute ago with research and development taking away complexity. Now you add a bit of complexity,
sure,
right? Because I have to think about as an employer, I got to think about the time I pay for that's taxed,
right?
And half, right? Because if overtime is time and a half, or double time if somebody who works on over the weekend or something, or over Christmas or whatever.
Right.
Time and a half, that half now is not taxed.
Yeah, so okay.
Yeah, but it's capped, right? It's capped up to $25,000 for married filing jointly.
And then it becomes taxable.
So
it's
and so this
is adding complexity.
It is adding complexity, and it's one of those things that most of the payroll, commercial payroll systems are pretty good at this, but it is something that if you don't understand or not sure you're doing it correctly, get with your payroll provider and make sure you're reporting it correctly so that you get your W-2s done correctly.
Now it is, but it's still all subject to FICA.
Yeah.
There's no exclusion on that. It's just the actual individual income tax, the withholding.
That's right. We've heard we had a problem with Social Security going to this trust fund.
So we're definitely not going to cut that, right?
We got to get all that money into the Social Security system.
Some way, yeah. Wow. Okay. So I guess employers, do they need to educate their employees on this, or?
I think you always want to educate your employees.
Yep.
Particularly, this is a good thing for many employees, but anytime you start making changes to employees' compensation, employees' paychecks, things start to come through maybe on their paycheck they haven't seen before.
Right.
I think it's always good to have those sorts of conversation.
Right.
And I think generally it's good to have communication with your employees anyway about what's going on. This is right. This can be a wonderful thing for employees to do or to have, a benefit for employees to have to protect their own financial futures. Right. And so, if you care about your employees, most employers do.
Sure.
Is say, hey, look, this is available to you.
Right. Well, the thing about the what I don't think was publicized as well was the cap on it.
No, that wasn't.
So, if you've got somebody that just works in an upscale restaurant, say, they hit that $25,000 pretty early in the year, and we're like, wait a minute, why am I being taxed?
Yeah.
So I think making sure that understanding the limitations and restrictions on it is also super important.
And the other thing that goes with that, in addition to the cap, is the phase out. Right.
Gotcha.
So if you if you have, I said, what is it, $300,000, it phases out for joint taxpayers. So
Wow, okay.
if you have a couple and they're relatively high income, but one of them makes their income off of tips or overtime, that benefit can be phased out. And so one of the things about the tax code, and it goes back to the changes that have happened. Just like we don't like uncertainty in the tax code, I always tell people I don't like surprises either.
Yes,
if I'm going to owe the money, I want to owe the money.
I don't want a surprise.
But I don't want to find out on April 15th that I owe the money.
Yes.
I want to find out as soon as possible in the year so that I can start to plan and think about it.
Yeah.
Right? Because I'm going to owe what I owe. But
yeah.
I want to know sooner.
I want to know. Yeah, I don't. Yeah. The fear of the unknown is a real deal.
Yeah,
that.
That's right.
I hate those surprises.
Yeah, I don't like that. Is not a surprise. That's not a good. That is not a good surprise.
No, that is not. I love good surprises.
Yeah, good surprises. Surprises finding out there's nothing really wrong with your car.
Yeah,
right?
Exactly.
Right.
Well, so did this bill do anything to help small businesses with the amount of paperwork that they're required to file on things, or is it the opposite?
No, well, there are a couple of good things that happen.
Okay.
You might remember that there was some conversation towards the middle part of the Biden years where they were going to change the 1099 requirements, and there was if you're one of those folks that sold on eBay or something like that, you're going to have a lot of new reporting requirements. Right?
Gotcha. Okay.
And so there's two primary forms that come into play. One is how they came up with the name 1099, I don't know that. Yeah. But there's one that's 1099 NEC. That stands for non-employee compensation.
Yes.
And there's another one, 1099 MISC, miscellaneous.
Yep.
And so those are going to be common ones that our small business constituency are going to be issuing to folks.
Right.
And the historically, what would happen is if you paid someone $600, you'd have to issue a 1099 MISC, miscellaneous. And the tax code OBA changed that to $2,000. Right.
Oh.
Yeah.
So I was unaware of that.
Yeah.
Okay.
That's kind of nice, right?
Good to know, yeah.
It's it's not a huge number, but at the same time you have a lot of. Doesn't take that long to earn $600.
Yes.
Right.
Sure.
Now I do want to caution people: just because you don't get a 1099 does not mean it is not taxable.
Report it. Yes, exactly.
Right?
Yes.
That's between you, your maker, and the IRS. But you still legally, if you get something for $500 and you don't get a 1099 for it, it is still taxable.
Right.
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 People always ask me, is it taxable? Yes, it's taxable.
But it does help the employers.
Right. It's just it's the IRS. It's the 1099. The IRS gets a copy and you get a copy.
Right.
But it's still taxable even if you don't get a 1099. So they did raise that limit to $2,000. There's also discussion about them changing the 1099 limits to basically $600, and this is going to affect people that do a lot of online sales, and they raised that back to 20,200 transactions. So,
oh wow, okay.
So I think that. And again, I'm not sure how many of our folks that's going to impact, but again, anything
we have a lot to run online kind of shops or whatever.
So that will hopefully make their life a good bit easier.
Right, right. That reporting piece of it.
Yeah.
So still have to track all that.
Oh, you still got to track. Yeah. You still got to track it all because if you paid
sales tax can show up and do an audit, and you better have all the detail.
You better have it, and you better have it all. And that's one of those things that again is always keeping good records, right?
Absolutely.
Keep good records for whatever you're doing, so you can justify that you at least made a good attempt.
Right. Not on the back of napkins, not on scrap paper.
Right.
Not carried around in a shoebox, or
at least if you're doing it on napkins, at least file them. Keep a file folder of napkins.
As long as they're like heavy duty napkins.
Yeah, right, exactly. Yeah, from a good restaurant.
Okay, gotcha. Okay, I like it. I like the way you think. It's all good. So
yeah, they're good.
Interesting stuff. So loans, lines of credit, interest rates are crazy. Anything going on with availability or reporting, any additional restrictions on financial institutions?
Yeah, something that's going to affect bigger companies is interest. The interest deduction. So, many companies will borrow money, right? They'll have a lot of credit, or they'll have, and so there was a restriction. There is a restriction. Now, generally, it doesn't affect companies that that are less than $31 million of revenue.
Okay.
But we got a lot of companies that have more than $31 million of revenue. For them, your ability to take interest deduction is limited. And it is limited based upon a formula. And many things in the tax code are based on formulas. It's based on a formula that essentially is your earnings less your interest and your taxes. So we call that EBIT, earnings before interest and taxes.
Right.
Well, they added something that's called earnings before interest, taxes, depreciation, and amortization. EBITDA, which essentially served the effect of making it lower, making the threshold lower. So I was limited to 30%, a 30% deduction of EBITDA.
Okay, right.
And so let's say my EBITDA was $100,000. I was limited to taking 30% of that, or $30,000 of interest deduction. Now I got to carry the rest forward, but
even that over time, how are you ever going to
And so they changed the formula. They got rid of the DA part, the depreciation and amortization, and
can be significant.
Right. So now it's just on earnings before income and depreciation. Earnings before interest and taxes.
Gotcha.
And it ends up being 30% of that. Now again, it doesn't affect companies that have less than $31 million.
So theirs should be deductible.
Theirs
they don't have to go through the gyrations. Yep. Okay. So bonus depreciation doesn't really have any impact then.
No, it's not going to have any impact.
Since it's changed it. Okay, cool.
See how all the pieces of the tax code work together, right?
Boy, what's up with that picture? I don't know what to do on that. Retirement plan changes. Anything going on there, whether it's 401k?
Some good stuff in retirement plans. I guess it depends on how you look at it. The biggest change is the fact that now if you're a highly compensated, or actually if you're making over $150,000. Okay. And I say highly. I started off by saying highly compensated. That's actually a term of art.
That's an old term.
Well, it still is a term of art within the 401k community. Mm-hmm. And so the terms are actually a little bit different in terms of one of them, the highly compensated, deals with discrimination testing under a 401k. $150,000 limit. At that, if you are making catch-up contributions, and folks who are making catch-up contributions probably know what they are, but if you're not, what a catch-up contribution is if you're 50 or over any time during a calendar year. So if you turn 50 on December 31st, you are eligible to make a catch-up contribution. And what the catch-up contribution allows you to do is it allows you to defer the same amount as everybody else, right? So whatever the annual dollar limit is.
Right.
And it also allows you to make a catch-up contribution, because the thought behind the law there is we've got a retirement plan. We have a retirement savings crisis in this country. Many people grow up, you raise your kids, you're buying your house, you're starting your career, you have no money.
You have no money to save.
Right?
Yep.
You finally get rid of the kids, get them off in their own area, and now you might have money to save, but you're behind.
Yep.
And so the thought behind the catch-up contribution is that now that you've got those kids gone, you can start saving, putting some of that money more into your retirement to save for yourself. And so 50 or over, anytime during the calendar year, you're allowed to do catch-up contributions. And if your plan allows, you can do them to the traditional pre-tax bucket, or you could do them to Roth if your plan allows. Under the change in the law, now if you make over $150,000, they have to go to the Roth.
Oh, so they're forcing you to pay taxes on it.
They're forcing you to pay. They're forcing you to pay taxes on that.
Okay.
Now that provision's been delayed a couple times, but it is effective now, and it was delayed because all the payroll providers and the retirement custodians went to the IRS and cried uncle and go, we can't get our systems ready that fast. So please give us a break. And so, but now it is effective.
Is there a limit on dollars on what you can do with that catch-up, or is it?
There's actually two limits.
Okay. Of course there are.
Of course. One is the standard limit for people that are 50 or over.
Okay.
Okay. And there's by the way, you can also do, if you happen not to sponsor a 401k plan or for your business, you might also still be allowed to do IRAs. And IRAs, individual retirement accounts, also have catch-up contributions.
Gotcha. Okay.
Okay. You mentioned SEPs, simplified employee pensions. No catch-up contribution there because
I had to mention the
you
one
had
that
to
didn't have it.
But
Yep,
those are all simplified employee pensions under the law for the last 15 or 20 years. Those have all been employer funded.
Gotcha.
And so no catch-up contributions there. Okay. But there is a provision so the standard provision for a 401k for a catch-up contribution is, I think it's $8,000 for 2026.
Okay.
Check the math though before the payroll provider before you do it.
Yeah.
But there's also something called a super catch-up contribution. Right?
Of course, okay.
Right.
Get your cape out.
Pull off
Put your cape on. We're all good.
This is a family show. We won't do that. But super catch-up allows you to do, if you're 60 to 63, allows you to make an extra contribution. And so I think that's 11,000. Look at my notes here. Yes, 11,250. But it's for people 60 to 63. Okay. And then after 63, it reverts back to the standard catch-up contribution that everybody
can. Oh, good Lord! Can we make it more complicated?
Well, we could. It's probably on the way. And I always wonder, like, why do they make it 63 rather than just run it right through
to 65
or 60, really? Even 67, which is the full retirement age. Full retirement age for many people. So. Two things that relates and not directly related to the One Big Beautiful Bill Act, but that does affect small businesses is this change in retirement law. One is if you're making $150,000 or more, your catch-up contributions have to go into a Roth component of the plan. If you don't have a Roth component in your plan, because it's an optional provision,
can't make it.
You can't make it.
Wow. Okay. So you need to find out.
You need to. Okay. If your plan 401k doesn't have a Roth provision in it, and you're the business owner, you got to put one in.
Gotcha. Okay.
And then the other thing is the super catch up. And
interesting.
Yeah.
Okay. Well, now that my eyes are glazed over, and I understand
this is job security for somebody, right?
I guess it is. It's a crazy thing. If you had one piece of advice you could give business owners, what would it be? And not necessarily on the OBA or retirement, or it could be anything. But what do you think is your experience, what you've seen, small business owners need to be considering or doing?
Not related to OBA and not related to retirement plans. I am amazed at how many business owners do not understand their own financial statements. I contend that financial statements are there to help you run your business.
I would agree.
And if you don't understand how your financial statements are put together, or your financial statements are inaccurate, or your financial statements are late, then you really are trying to navigate a trip without GPS, without a roadmap,
right,
without having really a clear idea of where you're going. And then what happens is you're just managing your business based on your checking account, which is, and it's frightening. A lot of businesses do it that way, where they look and they go, okay, we got money in the bank, we have some receivables, and we have some payables, and that's how they manage their financial outlook for their business. And I see a lot of businesses get into trouble
Sure.
that way, because they're not either they have a job, if it's a contractor, a job goes bad, or this is how business gets stolen from, right?
Absolutely.
You know, and so you've, as a business owner, you've abdicated that control over your financial records to a trusted bookkeeper within your business. And, you know, it's hard for me to steal from you if you don't trust me, right? And so, and it's easy for me to get away with if you don't understand your business books and records.
And my one piece of advice, and I tell every small business owner I come in contact with, open your own bank statement and look at it. You don't have to reconcile it, but open it. You're looking, because if somebody knows you're looking at it before anybody else has the ability, it's going to stop a lot of the embezzlement that takes place. And I 100% agree with you on understanding your financial statements. But it's all great. Trust somebody, that's wonderful. But not anybody. But just about anybody given enough freedom and nobody's looking, they get, I'm just going to borrow this till next payday or whatever.
Yeah, I don't think anybody sets out to say, you know what, I'm going to embezzle $200,000 from my employer. No. What happens is, as you suggest, it starts off as a small thing, and I'm going to put it back next pay period. Yep. But then I don't have the same conditions that caused me to not have money last pay period, caused me not to have money next pay period, and it just it snowballs.
Yep.
And it's the people that you trust, and I think that. Open your own bank accounts. The other thing is that I would add to that is I think that you should go through and review who you're paying.
Yes. Oh, absolutely.
And so ask people questions, because if you say, you know, I don't understand our relationship to this vendor.
Yes.
Or wow, we really seem to be paying them a lot.
We've seen so many over the years where somebody will set up a fake vendor. Now, then they're really orchestrating to steal from you, but they set up a fake vendor and they pay them. If you're not looking at them, you're not signing the checks, and you don't know everything kind of going on, I mean, you can get in a whole lot of trouble fast. We've had businesses go out of business. We've lost accredited businesses because of it, because of significant embezzlements.
Yeah, and it sometimes the sad thing is it happened. I've seen it happen to the same business repeatedly.
Wow.
You know, where they fell victim to one person who embezzled, and then it happened, and it happened again. But when it comes to that, I think that as a business owner, if you're managing the cash and looking at the cash flow in every aspect of that, whether it's a receivable or a payable or credit cards, who your vendor.
Get me started on credit card. That's a whole nother. We could have a whole session on that.
Yeah, we could.
That management.
So again, not related directly to taxes, but it can put you out of business super fast. Understand your financial statements. And the thing is just because you're in business, you know, you're great at whatever your business is, it doesn't mean you have to be great at accounting
or that
you were great at accounting.
Sure.
But get somebody to teach you. Say, you know what, I don't understand how accounts receivable work.
Right.
Explain it to me.
I don't need to do all the entries, but I need to understand.
I need to understand how it works. I want to understand how my books and records work, and keep asking questions on that till you get it.
Yeah, I 100% agree. Anything else you'd like to close with? That was pretty good stuff. We actually could probably expand on that and move that into another session later. So.
I can't think of anything except if anybody's watching this, why haven't they joined the Better Business Bureau?
Well, thank you. So you've been with us for a while.
I have.
And you love the information we provide to you. We've got great relationships.
That's right. That's right. I mean, I can't imagine not having it.
Well, thank you. We love having you. I can't imagine not having you. So
all right. Great.
There you go. Thank you. Thank you. Well, so that's all for this episode of Business and Beyond. Thank you for listening. And Wayne, again, thank you for joining us. I think you've given us some great information and some great things to think about. If you've enjoyed today's conversation, make sure you subscribe so you never miss an episode. We'd love to keep this conversation going, so please make sure to connect with us on social media and share your ideas for future topics or guests. And don't forget to visit us online at bbb.org. Till next time, keep building with integrity, leading with trust, and taking your business beyond expectations, the BBB way.